It's Brian Preston, the money guy.
All right, let's ask. This is one that I think will be really, really good. This is from Emily, and she says, "Young, investing 25% gross." Let's just pause there
That's
and
awesome.
say that's awesome. Good for you, Emily. She says, "Does it make sense to pay extra to the mortgage, knowing we'll move to a bit higher cost of living area within 5 years, and we want to put 20% down? Our current mortgage is 2.875%."
So, okay, realize this is why we are financial mutants, is that we are a maximizing channel. We are not here to, here to help you be as efficient and maximize all of your financial decisions as much as possible. That's why we sometimes get into discussions or people don't agree with us because they just think you got to get out of debt. Here's something that she shared, Emily, correct?
Emily, yep.
Here's something she shared that I have my own experience share from my own life. Is I tell you guys all the time that I like 30-year mortgages because right now interest rates are so low. They're below 3%.
Yep.
There has been a time in my life, realized my first mortgage was at 6 3/4.
That sounds crazy.
That sounds really crazy. And then my parents could probably tell you a crazy story
like
where it's
double
double
digit,
digits.
yeah.
So I've had a 15-year mortgage in my life back in the day when I was much younger because I was trying to avoid interest rates, and it was about 0.5% or 0.75% lower. But I did run into a weird situation where I had my first house that had not sold, sat on the market a little stale. I had a new house that I'd been building that for about 3 to 4 months, I owned 2 homes. That's not the best situation. I'll just go ahead and tell you from a cash flow situation.
Made things kind of tight.
It's not like I wanted a second house. It's just that I didn't stick the landing on the sale of the first house. I was kind of mad at myself for having that 15-year mortgage because it was really severely impacting my cash flow. Well, I'm going to now. That's not the question she asked because she's saying, should I put more money into this current house when I know I have a move coming in the next 5 years? I am. It's because it's the same decision. Once you put that money into the house, the only way you can get it out is by selling the house or taking a loan on the house. And I would tell you that Emily's probably going to want, when you move, first of all, where you think you're going to buy is probably going to be more expensive than you're counting on.
She even said higher cost of living.
It's going to cost more to build the house or buy the house. It's going to cost more for a higher cost of living area. I think you probably want to have a little more emergency reserves, a little more flexibility, liquid capital there so that you can make that transition easier. You're not going to be able to do that with any of that excess equity that you've paid down. You've paid down the loan and gotten that extra equity. You might feel good in the moment, but you're going to kick yourself a few years in the future because logistically you'll be like, man, I wish I had access to that cash that I paid into this house that now I can't sell. Now, if you're hoping you stick the landing, put the house on the market, first person that shows up and looks at it makes you an incredible offer, and then you're like, woohoo, I'm a genius. But I'm always trying to plan for, like a financial mutant would, not only what's the best situation, but what's most likely, but also what's horrible that could go wrong. Plan for all 3 scenarios so that you're not surprised and you make a really good financial decision.
Yeah, I'll tell you the way that I would handle it. And I think what you said was perfect, Brian. Just because you put extra money into the house does not mean you're guaranteed to get that extra money out of the house, and certainly the timing is not guaranteed. So if your move is still a couple of years off, and I think you said here 4 or 5 or even more, what I would do is that excess mortgage payment, rather than like paying that down on the mortgage and saving that 2.875% interest, I'd get my cash to a good level that I feel really, really comfortable in. And then I do think it's okay on that long of a time frame to start a dollar cost averaging strategy, maybe not into like a crazy aggressive holding. Maybe you don't want to be in a full equity holding, but something a little more conservative to get dollar cost averaging working on your benefit. Because the beauty is, in that time period, if you do see some volatility, as you're buying down. Well, even like in the middle of the COVID downturn, the market COVID downturn last year, if you looked at what your dollar cost averaging purchase in May was worth in June, it's close. If you look at what it was in April, you know what I mean? Like when you're buying a month at a time, you mitigate some of the risk. Now, it'd be a different conversation if you wanted to take all this extra money and put it in today, but dollar cost averaging gives you some insurance against market volatility. What that might do is you might likely be able to earn on those excess cash payments more than you're paying in the mortgage interest, and you're still 4, 5, 6, 7 years from now going to be able to use that money for that home purchase without having it tied up in the mortgage.
Well, and let me poke the bee's nest that's sitting in the tree over there. Is that I get a lot of comments from people saying you should always just pay down the debt. You know, while you have the debt, pay it down because you're not making 2.875 on your cash. The thing I always tell people, I'm always worried. Remember, I just told you want to have your awesome scenario, what you think is going to happen. Then you want to have, oh my goodness, this is really bad, where bad things all happened at once. You realize when you start prepaying the mortgage early, I'm talking about people sub 45, when compounding interest is the most valuable. If you get into a pickle of a situation, you get squeezed, meaning you need to come up with cash flow. It's going to be hard to get it out of the house. And that look, there is definitely an easing up on your cash flow when you're paid off your debt. But the problem is it might take you 10 years to pay off the debt. So if you paid it down and you're in year 8 when you lose your job, you're going to really wish you'd put that money into something that you can get access to much easier than taking a loan or selling the asset, because you're going to be like, I paid down 8 years and this is what how do I get my money? I have no way to get this money out without selling it or taking another loan. And sometimes you can't take a loan. Think about 2008, 9, 10, 11, where market values on paper were so much below. You couldn't get a loan, even if you wanted to, and you couldn't sell it. You'd be so thankful that you had access. And that's the thing I always say, because everybody always says, you'd be better just paying off the debt. I'm like, what if you lose the job and you weren't able to do this stuff? I'd rather have access to the money.
I'd rather have the liquidity, for sure.